we were talking about the mid-cap IT space, which continues to be under pressure. There's also a note from Kotak on the IT services space. You want to take us through that?
Yes. So basically what Kotak is saying, and again they're highlighting how there is increased risk for Indian IT companies in their growth given the global banking turmoil. So they go on to say that the banks, the large US banks, were large spenders on technology over the last couple of years. And even this year, the early indications were that large US banks will be spending on tech because they want to be digital first. They want to make sure they're modern now and they can compete with fintechs. But now, given the turmoil taking place in the large US banks, their priorities is going to be on capital conservation, on making sure that they have adequate liquidity. So therefore, they may choose to hold back on their tech spends just to be prudent, right? In that case, then there is a risk that discretionary budgets, the tech budgets by banks, will get paused. So this is how Kotak sees this playing out. They're saying in the current quarter, March quarter, Q4 of FY23, there is a risk to growth estimates. The growth can be impacted by 1 to 2%. That's in the March quarter. In the next quarter, in the June quarter, Q1 of FY24, they start seeing things normalizing. And in the second half of FY24, things will, pick up and perhaps get back to normal. But just in the immediate March quarter, they are anticipating growth rates could come down by 1 to 2%. Amongst the lot, they think Infy and TCS are well placed because, they can straddle all the, work that clients may require compared to, say, a Cognizant and Wipro. So that's, one more view coming in on the impact of IT, given what we are seeing globally. So let's welcome our first guest on the show. He's been a close watcher of the technology landscape in India for the last many decades now. Girish Pai, the head of research at Nirmal Bang Institutional Equities, is now with us on the show. Girish, before I get your thoughts in on tier 2 IT companies, the LTI Mindtrees, where you have initiated coverage, so we'll get to that in a bit. But first, wanted to understand your thoughts on how you see the current global banking turmoil play out on the Indian IT and the risk to current growth in EPS estimates.
Yeah, good morning, and thanks for having me on your show, Rima. So BFSI is a fairly large exposure from an Indian IT services perspective. If I look at the NASSCOM numbers, it constitutes almost like 40-41% of total sales. And what has been happening in the last 12 months has been that certain parts of it have been been weak. The mortgage part has been weak. The capital markets part has been weak. Certain parts of insurance, especially the PNC part, has been weak. But the banking piece, the lending piece, has been kind of holding up because asset quality was not a problem or has not been a problem thus far. The NIMs have been expanding last year, and they're expected to expand even in 2023 if I look at consensus estimates. But the way things are kind of panning out in both US and in Europe, my sense is that there is going to be collateral damage on the banking system in both US and in Europe. And these constitute the largest, the bigger, systemically important banks constitute the large clients for the Indian IT services companies. So the regional banks, I don't think they are very large. I don't think Indian IT service industry has got a very large exposure to them, at least the companies that have kind of made public statements on that. The exposure seems fairly small, but indirectly, I think the regional banks could have a very big impact on how the IT spend could happen in the coming days ahead. Because from whatever I gather, the so-called mid-sized banks in the US constitute almost like 40-50% of lending. And to me, it looks like that's being kind of frozen as we speak. And if that happens, I would probably say that there is going to be a risk, significant risk to US economic growth. And consequently, there could be bigger asset quality problems that could happen for the main banks, the systemically important banks. And I think there is also a situation where NIMs, instead of expanding, will probably not, they may not expand as much in 2023 as the street kind of believes. So I think earnings could come under a lot more pressure than what consensus is currently believing. So I think that this whole situation is a bit of a challenging one for the Indian IT service industry, and we'll have to probably watch out how the guidance come out for some of these companies when they do so post the fourth quarter.
That's a sobering thought, Girish. Good morning, and thanks for joining us, Surabhi, here. Let me sort of follow that up with maybe some more specifics. I think a lot of people on the street are bracing themselves for the impact in terms of just the top line hit. By how much do you think consensus estimates will have to be lowered let's say in constant currency revenue for the top tier companies? And is the impact going to be more on the top line, or do you think they can get by lowering margins, lowering price, and then perhaps getting by without too much of a top line hit?
So Survi, so my sense is that the consensus estimates are currently factoring in about high single-digit US dollar revenue growth for FY24 versus 23. My estimates are below consensus. They're probably in that 3 to 5% range for tier 1 companies. From a margin perspective, my sense is that the consensus building in margin expansion going into FY24 versus 23. Yes, there are quite a few levers out there, but I think what the consensus is not currently factoring into the estimates is a potential pricing pressure. If I look back in history and look at 2-3 episodes in the past, there's been a fair amount of pricing pressure that Indian industry has kind of had to weather. And I foresee that even in the kind of environment that we're kind of building in. So we are building in an explicit shallow recession in our estimates with a potential downside. So my sense is that, the street has to kind of pull down its estimates on both revenue and on margins going into the next couple of quarters. So the narrative has been that, just as was Rima was discussing, that next couple of quarters are going to be weak and things should start improving from then on. My own take is that things are going to get worse, at least for, just beyond the couple of quarters. So it's going to be really a slightly more protracted, pain for the industry.
Girish, you said you are at 3 to 5% constant currency revenue growth with a downside possibility even to those estimates, right? Given what's going on.
Right. For tier 1 companies.
Okay. Tier 1 companies. Okay.
All right, Girish, you were saying that, we should expect maybe a little bit more than a couple of quarters as well, right? In terms of the pain that the overall industry could see. What are you estimating? How much time do you think that this is going to last? If you're saying it's going to be beyond a couple of quarters, how long do you expect this kind of protracted pain to last?
Yeah, that's an interesting question. So there's this whole discussion around whether it's going to be a V-shaped recovery or a U-shaped recovery. Okay, we will go into a downturn. Will we come out of it in a V-shaped fashion? It all depends on whether the Fed is able to engineer a swift decline in interest rates and probably go into a potential QE kind of a situation. And that depends also on whether inflation in the US comes off very materially and down to like the 2% levels that the Fed wants. So it all depends on how inflation plays out. If we do have a situation where inflation comes off dramatically to the 2% number, then we will probably see a V-shaped recovery on the fundamental side in FY25. So we'll probably see a very whiplash kind of a situation where growth could be very strong. But if that doesn't happen, if we have inflation continuing to be a problem, we will not see interest rates go down very materially. We will probably not see a QE. Then we will see the 2000 to 2003 kind of situation where, we saw a U-shaped recovery where stocks did move up and down quite a bit, fairly large moves. But that could probably be the norm if we do see, inflation not coming off very materially.
Just want to throw up one more data point. Now, yesterday we got the news about how tech layoffs are continuing globally. Amazon announced that they will be laying off 9,000 more employees. This is the second round of layoffs by Amazon. The first round took place towards the end of last year when they let go of 18,000 people. The difference between the two is that this time the layoffs include also their cloud employees, AWS employees, the Amazon Web Services, unlike the first round, which only catered to the corporate employees. So in a way, many people were saying, well, the corporate headcount has come down, but the employees who were focused on tech, they were still, they didn't lose their jobs. So therefore, tech was resilient. But this time, AWS, which is purely tech, the cloud services, their employees are also going to be let go as a part of this. And this perhaps indicates that maybe demand is petering off even for these companies. And look at the growth rates of AWS and how they've come off over the last couple of quarters. In the last reported quarter, AWS's revenue growth was about 20%, which is almost half of what it was a couple of quarters back. And remember, most of the Indian IT companies got the bulk of the alpha growth, the big growth numbers from all the cloud-related work, migration, modernization of apps, etc., constituted were the big growth drivers for IT companies. You want to comment on this, Girish, what we are seeing in terms of a cloud slowdown now?
Yeah, so I think that's a cyclical phenomenon. I think, yes, in the kind of macro environment we're kind of getting into, I'm not surprised that what has happened with growth on the cloud side and also the kind of layoffs that we're seeing there. So just one point on the structural growth, a lot of people keep talking about the industry. One should be valuing some of these companies at higher multiples than what they were pre-pandemic. I have a difference of opinion there. My sense is that the growth for the industry will probably be like 100, 200 basis points faster than the pre-pandemic levels, not the 300 to 500 basis points faster number that a lot of people on the street kind of keep talking about. Yes, digital and cloud will continue to be a driver of growth in the 5 to 10 year time frame, but I think the tech intensity will kind of come off because I don't think interest rates, at least the sense I have is that I don't think interest rates are going to go back to the 0% levels that one has seen pre-pandemic. So I think we will probably not see, the corporate health being as good as, or corporate profits being as high in terms of as percentage of GDP. I think they hit about 12, 13% during the pandemic. I don't think they're going to go back to that kind of a number very soon.
Girish, take all of your caution on board, but as we're winding up, let me ask you this. Aren't the stocks factoring a lot of this in? I mean, we kind of tend to forget, which is why I just went and checked how much they're off the peak. I mean, Infy is down 25, 26% from the peak. Wipro is down 35 to 40%. HCL Tech is slightly better off. TCS is better off. But even there, we're talking cuts of 10% to 40% from the peak for IT stocks. They've been in a bear market anyway. So to what extent is this worst case scenario priced in?
Good point, Surabhi. So I think if you look at the kind of performance that the IT index has delivered in 2020, it delivered a 55% return. In 2021, it delivered a 60% return. In 2022, yes, it came off by about 26%. So while it has come off from the peak by quite a bit, if I look at where the stocks were or where the valuations, I think that the important thing is to look at valuations. Valuations are much higher compared to the average levels that the stocks traded at in the pre-pandemic time frame. So my take on the sector is that while the companies are great cash flows, great return on capital, great corporate governance, a lot of capital being shared with shareholders and stuff like that, but I think growth is going to be a challenge, and more importantly, valuation is going to be a challenge. So at current valuations, if you buy the stock, my sense is that over a 5-year period, if you ignore all this discussion around recession, no recession and all that, I think you'll probably get a mid-single digit to high single-digit return on the tier 1 stocks, because I do potentially see some bit of PE multiple compression from here on.
Okay, got that. Thanks very much for joining in, Girish. Great conversation as always. We look forward to catching up again. Let's see the next couple of weeks once the earnings season kicks in, what the companies have to say. Thanks for being with us. We'll take a break on that note. On the other side, we'll discuss everything that's buzzing in the commodity space. Manisha.